Welcome to our webinar on Focused Financial Modelling. My name is Tony Carlton and I'm the Director of Corporate and Professional Education for Macquarie Business School. Is your organisation financially resilient? Will it survive long enough to come out of this pandemic ready for growth? These are fundamental questions, and the answer lies in understanding the cash flow dynamics of your business. One of the key tools for understanding these dynamics is the financial model. Dr. James Hay is going to talk us through some of the key issues in how we can use financial models to better understand our business's financial resilience. James is an experienced corporate financial advisor and consultant with extensive experience in the resources sector. He is also a highly regarded educator. He teaches financial modelling for Macquarie University's Applied Finance Centre and also teaches short courses for Macquarie Business School in financial modelling and financial analysis. This webinar will be recorded and made available to all participants. We encourage you to use the chat forum to raise questions during the webinar, and there will be time to address those questions at the end. You might also want to minimise your speaker gallery, which should be on the top right hand of your screen. I would now like to hand over to James. Thank you.
Thanks, Tony. Well, today my presentation is primarily directed at the non-accountants and the non-finance people. Those people who might have some financial management responsibilities, but it's not your core skill set. And you might be using Excel and using Excel models, but it's not your primary area of expertise. So let me just share my screen. And I'll bring up my, my slide presentation. So I'm going to focus on three things. First of all, how a dramatic disruption like the COVID-19 crisis can suddenly change what we want from our financial models. So in other words, how we might reframe the questions that we are asking of our financial models. Secondly, I'll talk about cash flows and why we focus on cash flows and cash flow modelling in particular during times of crisis. And thirdly, I'm going to talk about good modelling practice and how good modelling practice can not only help us to endure the crisis, but can also position us to take advantage of the recovery when it does actually occur. So financial models are built, or they should be built, to address specific questions. But in this environment, the questions have changed. So under a business as usual scenario, our modelling is usually looking at questions about growth opportunities or value creation or the profit outlook. And the base case, the business as usual scenario is really what happened last year. How are we going to build on what happened last year? But you get suddenly hit by a crisis and suddenly the questions will change. So our questions now, we've got these dark storm clouds. Our questions are about survival and short-term cash flow and taking advantage of what support opportunities might be available to us. Now, the great philosopher, Mike Tyson, said, everyone has a plan until they get punched in the face. And so from a financial planning point of view, we've all just been punched in the face. The plan we had in January is no longer valid. Things have changed terribly. So we might have endured all sorts of different things that we weren't planning for. Things such as big drops in revenue, or as individuals, big drops in income. We might have a huge call on refunds. So some companies are not only enduring a drop in business or a huge drop in business, they're also being asked to refund the monies they took in the previous periods. So the travel industry in particular is being called on to make refunds. And you might be on the other side of that transaction. You might be seeking a refund, but you've been given a voucher. So you might be in the position where you've, you booked your Virgin flight, you've had to cancel, you wanted your cash back, but you've got a voucher instead, and you've got to hope that one day you might be able to redeem that voucher. Interrupted capital projects. So companies might be halfway building, through building projects. There are shipyards all around the world with half-built cruise ships. So cruise companies have to decide whether to continue with that build, if they even have the cash to continue with the build, or if you're the ship builder, you have to consider the possible outcome that you might be left with a half-built cruise ship with no customer to pay for the finish. Or as an individual, you might be halfway through building a house or making the decision whether to continue with a house build or to progress with a home extension. So what you thought was the situation in January where everything was all mapped out has suddenly been interrupted. A working capital crisis. So you might have a slowing in receivables. So, you know, business might have dropped off somewhat, but your customers are paying you more slowly. When you give your customers time to pay you, you are essentially lending them money. So you're a line of credit for your customers, and customers will be taking advantage of that line of credit by slowing down the payments they make to you. So that's what we call a working capital squeeze. Similarly, inventory is also a working capital item, and there might be supply chain issues. So we might have unsold inventory piling up, or difficulty sourcing inventory at the right cost. Now, because this is a Zoom webinar, it wouldn't be complete unless we did a poll. So we're going to poll you and see if you as within your companies or even as individuals have been impacted by any of these sorts of issues. And you can select more than one. So any of these punches in the face, as Mike Tyson would say, that you might have endured. And if you've got any other examples, you could possibly put them in the chat box. Okay, it looks like we've got a fair array of impacts. I'll give you another. People are still choosing. Good to see. Looks like people have multiple impacts that they're enduring. Okay, let's end that poll and have a look at the results. So obviously, well, yeah, it's not surprising, I guess. A lot of people are enduring a big drop in revenue or income. Interrupted capital projects, looks like 13 people have got interrupted capital projects that they're having to manage. And working capital issues, both receivables and inventory. And there's a few people out there, it looks like they've got vouchers from, you know, Virgin or Qantas that they're wondering if they'll ever be able to redeem. Okay, that's great. So we need to understand the cash flow impacts of all of those events on our personal circumstances or on our business. And in times of crisis, it's never truer that the big issue is cash flow. So the primary question for many people or organization is, when will I run out of cash? What can I do to make sure that I don't run out of cash? And if you've been on any sort of finance course, you know, finance for non-finance managers, or even done any, you know, accounting degrees, the one lesson that gets drummed into you is that cash is king. Cash is the lifeblood of the business. Cash is used to pay suppliers and employees. Cash is used to pay the interest on our debt and make the repayments of our debt. And ultimately, cash is used to make returns to owners via distributions and dividends. So cash is king. Now, profit is important. Profit is a more holistic measure which considers past investments in the business and future provisions for events that are going to happen down the track. So it's important that companies make profit in the long term, but cash is what determines day-to-day survival. And like I said, any finance course you might have done, you would have been told that profit does not equal cash flow. And the type of example we usually use to demonstrate that is we talk about a company that might be making sales, have a lot of revenue on its profit and loss statement, but has a lot of bad debts. If your customers don't pay you, you will run out of cash. And so there are examples of companies that have reported profits and then have suddenly gone out of business because their customers don't pay you. Now, in this situation, the reverse is also true. Companies might be reporting accounting losses, but it doesn't necessarily mean that they've run out of cash flow. A profit and loss statement is also hit by a lot of non-cash items like depreciation and provisions. So particularly in this coming reporting season, we will probably see a lot of companies reporting large losses because they're making provisions for future events, but it doesn't necessarily mean they've run out of cash. So we need to look at the profit and loss versus cash flow equation from both sides. So when we're concerned about our survival, our attention is drawn to our cash balance and our ability to continue to pay suppliers and employees. And it may mean that we need to consider drastic, unusual, or creative sources of cash flow. And the idea is we need to identify all these sources of cash flow, quantify them, and prioritize them. And that's where the financial modeling comes in. Financial modeling is the tool to identify, quantify, and prioritize these cash flows. So by drastic, I mean things like sacrificing future customer loyalty in order to generate current period cash flow or preserve current period cash flow. Those companies that are offering vouchers are not doing it because they think it's going to engender a great deal of happiness amongst their client base. They're doing it because it preserves their current cash flow. They know there will be a cost to their longer term business outlook, but it's a drastic measure in order to preserve current period cash flow. Our creative sources of cash flow might be looking at your business or your business setup and saying, well, how can we reconfigure this in the current environment to generate new sources of cash flow? So restaurants that have never had takeaway businesses are suddenly, delivering to their customers. We've seen gin distilleries convert their gin production line into hand sanitizer. I would have thought the demand for gin was increasing, but apparently they're also producing hand sanitizer. And unusual sources of cash flow, perhaps the most unusual one that I've seen in the last few weeks is getting free money from the Australian Tax Office. There's been a number of programs. There's the Cash Flow Boost 1 program that small companies didn't even need to apply for. They just needed to withhold some tax from employees and they would have received some free money in the last week. So there's the Cash Flow Boost program. And then there's JobKeeper, which everyone was very excited to see. So the government pays you money so that you pay your employees. And the interesting thing about JobKeeper was that initially there was a lot of excitement, but then the detail showed that it's paid in arrears. So you need to fund the JobKeeper payments upfront and get the money back off the government down the track. So to understand that and to understand whether you can actually even afford to participate in JobKeeper, you need a financial model to understand the impact. So we also need to understand and manage our costs, both our fixed and our variable costs. So understanding indeed, are the costs that we thought were variable, are they truly variable? Some of them might be semi-variable. If you think of a utility bill, a power bill, there can be a supply charge as well as a usage charge. So even though your production has dropped to zero, you still have the supply charge to pay. So it's not a truly variable cost. We also need to drill down and look at our fixed costs. So things like your insurance levels. Is the current insurance level appropriate given the level of business you're doing? Your rentals and lease agreements, can you come to arrangements with landlords to delay or modify the rental payments? Subscriptions, even as individuals, if you look at your credit card statement every month, well, if I look at my credit card statement, I see all sorts of subscriptions, Spotify and Netflix. Can I modify some of those subscriptions in order to preserve my cash flow in the short term? And also managerial salaries, which are generally an overhead. Can we get our managerial salaries to be reduced, give everyone a bit of a haircut whilst we sustain the crisis? So the idea is once we've identified all of these various opportunities, drastic, unusual, or creative sources of cash flow, we need to, having identified them, we need to quantify them and prioritize them. And that's where the financial modeling is so useful. So we talk about good modeling practice, and good modeling practice can be put to the test in this sort of environment. And so with good modeling practice, I'm talking about things like making sure your model is robust under extreme scenarios. So we are currently experiencing an extreme scenario where your revenue might go to zero. And maybe your model was never built with the idea that revenue would go to zero. And when you put zero in as an input, you get a lot of error messages. So can your model cope with the current extreme scenario? Does your model have the granularity or the detail in the areas you require so that you can focus on these new critical questions? So your model might have been built to answer questions about product mix or pricing. Does your model have that level of detail so you can now start drilling down into your fixed and variable costs? And if not, do you have the skills to modify your model? So let's look at an example. I've got a small spreadsheet that I'm going to share with the class. So this is pretty simple. I've done it so that it fits on a single worksheet, but this is a simple cash flow budgeting model for let's say a small company. And it's a typical model. We've got some actual financial results and a forecast, and the inputs are separated out. So we've got inputs with a blue text on a yellow background, and calculated cells are just red or black text on a white background. And whoever built this model was clever enough. They said, oh, I'd like to look at my business under a couple of different scenarios. So, you know, the business is going gangbusters, business as usual, and not so good. So it's a revenue-driven model or a revenue growth model. I'm changing my assumption about how revenue will grow on a period-on-period basis. And then that also then drives what my various costs will be. So I built this model maybe last year when my worst case scenario might have been that my revenue would only grow at 0.5%. And now I'm in the situation where my business is being shut down, and I actually want my forecast for the June quarter to be 0, and then for business to resume after that. So, well, maybe I'll change my input. If I change the input in the not so good scenario for that June quarter to just 0, well, that just means that the revenue only grows at 0%. So that doesn't get me where I want to go. Well, what if I say minus 100%? Oh, well, that certainly gets me the answer I want for that period, but it also zeroes out the whole cash flow forecast. So that's not what I want either. Now, there's probably ways to manipulate those numbers, you know, minus 99% and plus 10,000%, but it's a pretty clunky outcome. And so what I want to do is I'd like my model to be able to cope with the current extreme scenario. And the second example I'll give is maybe this model was all about revenues and forecasting revenues, and there's not a lot of granularity or detail on the cost side. But now we've got this new unusual source of cash flow, which is the JobKeeper allowance. And I want to include it in my model, but I don't have an input field. So the temptation that must be avoided, the temptation is to go into your calculation cells under salaries and say, oh, well, the government's going to give me $80,000. I'll just add in 80 into that cell. And then there's going to be another, 120 the following period. And then I'll need to get back to normal. So I'll add 240 the following period. And I say, oh, well, oops. Let's leave that one off. I'll say, well, that's great. That gets me the answer I want. But the problem with that, of course, is you've just corrupted your model. And so I might get the answer I want for that important management meeting in an hour's time. But then if I come back to this model 3 months later or a year later, I might forget that I've hard-coded numbers in. So that's not good modeling practice. So we need to modify our model. So here's one I've prepared earlier, as they say. And I've made 2 changes. I've drilled down, and it's good modeling practice if you can, to try and drill your inputs down to the physical drivers of the business. So instead of a model that is just a revenue growth model, I've changed it to a model that looks at what I'm selling. It says, what am I selling? What's the volume I'm selling? And multiplies it by the price. And that gives me my revenue. So if I change it to a COVID-19, or I've got a new scenario in here, I've called it COVID-19. And I've said I'm going to produce 0 for these 2 quarters, but then production will go back, or gradually resume back to normal levels. And so I've modified my model in a way that it now has that detail that it can cope with the extreme scenario. So that's a pretty simple example. And then instead of modifying formula and hard coding in JobKeeper payments, I've created a new field, and I've made it quite clear that it's an input field. So I've formatted it with the yellow background and some blue data. So I can actually add the cash flow payments that I might receive from the government in those periods. Okay, and that solves my problem. Gets me back to a granular model, gives me the detail, and that's not corrupted. So a pretty simple example. Let's go back to my presentation. And then the other situation might be the opposite. You might have this mega model that was built to answer every question. It might have been built by a high-priced consultant, or it might have been built by a succession of employees over many years where different people have added to the model, and you've inherited the model, and maybe you really only understand 20 to 25% of the model, but you've used it to answer the questions that you need to answer in the past. So the problem with the mega model is they lack transparency, particularly if you only understand 20% of it yourself. That can be very difficult to modify to deal with these new extreme scenarios. So you want to have those spreadsheeting skills to either modify the model or even to start again with a clean sheet and build the model that's fit for purpose for your needs. And with that in mind, you'll never be more thankful of what we call the keep it simple approach, the skills to build effective and transparent financial models. And in our financial modeling courses, we talk about good modeling practice. And that's a number of the things I've already mentioned so far. But the first one is plan before you build. So you need to ask yourself, what is the question that I have that I want my model to answer? The biggest mistake people make is to start modeling before they've fully decided what it is they want this model to do. So you need to say, what is the intention of this model? What are the questions I have? What do I want answered? What is the nature of the data that I have, which I'll put into this model? So your model structure can be driven by the data that you have. Break up your formula. There's no prizes given for the most complex model. Models should really be transparent and as simple as possible so that other users can pretty easily audit and understand and follow through the model. You should test your model. So you should try your model with extreme scenarios. So revenue going to 0 or revenue growing at 1,000%. Does your model hold up under these extreme scenarios? So we talk about trying to break the model to test it, just testing its robustness under different scenarios. And of course, you need to build in checks. In a financial model, sometimes the easiest check is just making sure the balance sheet balances. With a cash flow model, you can add up your cash flows in two different directions, across the page and down the page. Can you resolve all of your cash flows in two different directions? So different sorts of checks to ensure that your model is robust. And I'll reinforce it again, avoid the temptation to hard code data to get the quick and easy answer, particularly when you've got that meeting in an hour's time and you need the answer. You really need to avoid that temptation to just modify formulas to get the results that you want. So what are we talking about when we talk about financial modeling? There's different sorts of financial models. There's what we call three-way financial statement models, which are just forecasts of balance sheets, profit and loss statements, and cash flow statements. And you can look at a company given a certain set of assumptions or scenarios. What does the balance sheet or the P&L look like projecting into the future? You can do valuation models where you're basically building the model to make a decision. Should I invest in this project? Should we expand the business? What is the value per share of this company? And they tend to be longer time frame models, the financial statement models and the valuation models. But like the example I just showed you, there's also budgeting and forecasting models, which tend to focus on the shorter periods. So they might be weekly or monthly models. And those sorts of models often sit behind the management reports you might receive. The monthly report that says, what's our year-to-date result? How does it compare to the budget? And what's our forecast for the remainder of the year? So no matter what sort of model you're trying to build, you need to think about the time frame. So is this an annual model? Or if I'm worried about cash flow for survival, maybe the time frame is quarterly or monthly or even weekly. You need to think about building some flexibility into your model. So the simple example I showed you had the capability for 3 different scenarios. There's no limit on the number of scenarios you can build into a model. So you want to model for different sorts of lockdown scenarios, for example, 2 months, 4 months, or what happens if we get locked down again sometime in the future. So the ability to have that flexibility in the model means that you can have all your different scenarios in a single model. You're not saving multiple models with different data inputs. And in line with that, you need to model for the crisis, but you also need to start thinking about the recovery. What are the different ways we can, recover out of this situation and take advantage of the recovery when it occurs? Okay, so we're getting close to time. There are a couple of resources that we'll send you the links to after this presentation. A Deloitte document on managing cash flows that focuses on working capital, a Westpac resource that focuses on sources of cash flow, business lending or government support, and a McKinsey document that focuses on communicating with your various stakeholders to manage the cash flow crisis. Okay, let's throw it open to questions now. I'll stop my share. Suzanne, do we have any questions?
Thanks, James. We do. We've got a couple of questions. The first one comes from Debbie, and her question is, can you expand on plan for the recovery?
Yes, so it's easy to get totally consumed by the crisis and managing our day-to-day cash flows, but we need to think about the different ways recovery might occur and whether we've got all our ducks in a row to take advantage of that recovery when it does occur. So that might mean making sure that the pipeline is primed. So do you have the inventory you need to produce whatever product it is that you make so that you can supply customers when they do come in the door, when they're allowed to come in the door? It might also mean of taking advantage of the downtime to reconsider your business, retool the business or reorganize your business processes. And the other way to take advantage of the recovery is to take advantage of the downtime now to perhaps execute some capital investment projects and expand your business or change the nature of your business. There's no marginal cost involved now for doing those sorts of projects because you're shut down anyway. So there's different ways that you can reconsider your business to take advantage of that recovery when it occurs. And a financial model is the best way to test those different plans.
Fantastic. We have another question from Aranita, and that question is, what do you mean by a three-way financial statement model?
Right, yeah, I probably skipped over that pretty quickly. So the three ways are the three financial statements that all companies produce, and you see them in an annual report. So if you pick up the annual report of any publicly listed company, after all the pictures of smiling employees and happy people, you'll get to the financial statements and there will be a profit and loss statement, a cash flow statement, and a balance sheet. And they are all interlinked and they show different aspects of the company. And so a three-way financial statement model takes that actual financial data from the annual report, and then given a number of assumptions, we then try and project what will the balance sheet look like in 4 or 5 years' time, or what will the profit and loss levels be in 4 or 5 years' time, or what will the cash flows be over this horizon. So we forecast what the company will look like using those three financial statements, and that's why we call it a three-way financial statement model.
Okay, we have another question from Kim, and that question is, how much accounting knowledge is assumed?
Okay, none. In that, I assume that's referring to the short courses we do. I usually open the course by saying, welcome, I'm not here to turn you into an accountant. I'm here to give you a bit of language so that you can have a conversation with an accountant and to know what are the right questions to ask of the accountant. So accounting is the language of business. So we need to be able to speak that language to a certain degree, but we don't have to actually become accountants ourselves. So the financial modeling courses, for example, will include a bit of an accounting overview where we actually go through those three financial statements I just spoke about and we describe them. And we also explain how they are interlinked, but there's no accounting knowledge assumed. And if you want to get a bit more fundamental accounting and finance knowledge, you can also do the finance for non-finance manager short courses that we do at Macquarie Business School as well.
Okay, we have a question from David, and that question is, how common is balance sheet forecasting, say in different size companies of less than 5 million or 5 to 10 million, etc.?
Probably for longer term forecasting, it's probably not terribly common. They probably focus more on profit and loss outlooks and cash flow outlooks. For larger companies, I think balance sheet forecasting is very common. And it also depends who's actually doing the forecasting. So companies themselves will want to look at their own balance sheets and how they're trending over a forecast period. But of course, you've also got people in the market, buy-side analysts and sell-side analysts, who are also modeling all these businesses on the basis of their publicly available documents. And that three-way financial statement model is usually the starting point out of which they pull the cash flows in order to do a valuation. So it's probably a good question in that it's probably more common the larger the organization you're looking at becomes, and less common in smaller organizations, which tend to be focused more on P&L and cash flow impacts.
Okay, we have another question from Adnan, and that is, when we were just on the spreadsheet earlier, why not use Monte Carlo and use P50 to model for risks in the business rather than looking at individual scenarios separately?
There's lots of different ways you can handle sensitivity analysis. Personally, I actually don't even like the Monte Carlo within Excel. If I'm using a Monte Carlo analysis, I tend to use an add-on program like Crystal Ball or At Risk. But really for that, and sure, you can, under a Monte Carlo analysis, you can look at multiple sensitivities within the one snapshot. So I come from a resources background, and we will use Monte Carlo analysis where we will model reserve outcomes and oil price outcomes and exchange rate outcomes with different distributions for all of those inputs. But to be honest, for the sort of cash flow modeling, short-term budgeting, questions that this particular, that particular company, in my example, I think Monte Carlo analysis is probably a step beyond where they, where they need to be to answer some of those fundamental questions.
Okay, and that's all for questions so far.
Okay.
So I think we're closing off. Just checking nobody else has any other questions. Yep, closing questions.
Okay, so thanks for that. You won't have all the answers, but I hope you have a better idea of the questions you should be asking of your financial statement models, and maybe inspired to elevate or brush up on your financial modeling skills. Okay, so back to you, Tony.
Thank you, James. Our follow-up email will include links to the resources mentioned by James. We also offer short courses in financial modelling. Keep your eye out for future webinars and short courses. Otherwise, I hope that you all keep well and keep modelling. Thank you.